Hi, everybody. I'm Scott. This is Rezwan.
I'm Rezwan. Hi.
So just to start, what we want to do, I think, is just demystify the IPO process a little bit. We have 2 slides. We're going to take 10 minutes maybe on each one, and then we'll open it up for questions. Rez?
So we've been hearing a lot of people talk already this morning about quiet periods. So let's back it up and put the legal framework as to what that means, when it starts, what it's all about. So the concept of the quiet period, why it exists, and by the way, it used to be much more stringent than it is today. So everybody still lives in a paranoid, fearful world around that concept of a quiet period, but let me lay it out and why it exists. So back in 1933, when the SEC passed the Securities Act, essentially what they said is, look, the only thing we want you to do if you're going to sell and market securities, we only want you to use a registration statement. We don't want you to use any other written materials. We don't want you hyping your stock in any other ways. And so what developed was law as well as SEC enforcement practice, which essentially said anything you did to hype your stock related to an IPO around the time of your IPO could be viewed as an offer, quote unquote. Well, the rules say you can't make an offer other than through your registration statement. So that's where everything developed to where even if you're going on interviews and you're doing, investor meetings or you're putting out press releases, any of those could be perceived as an illegal offer. And that's how the law of the quiet period developed. It's not nearly as stringent as all that, and so over time, there's a lot of nuances that people can work through. But the long and the short of it is, look, don't talk about the IPO, by and large, publicly, number one. Don't talk about forward-looking guidance around metrics or financials. Don't do new marketing initiatives after you've commenced your IPO process. If you do ordinary course initiatives, if you continue to focus on why your company, its products, solutions, services are good for customers, business partners, do all of that, you're probably going to be fine 99.9% of the time. Just avoid things that look like you're marketing towards investors during your IPO, and you're probably going to be okay.
Yeah, I mean, when we were doing the Truly IPO, there was a lot of new legislation that had actually come out. One of the things we're going to talk to you a little bit about is the testing the waters process, which is something that was very new a decade ago, and now it's pretty common practice. But to what Rez said was it's very different than what the rules used to be around how you could go out and talk to investors. So maybe, should we go to the first slide and just talk about the cast of characters who's involved and what they do? And, if you want to raise your hand and interrupt and ask questions, we're happy to take them as we go. So the first group is really the company folks, the company executives. Your CEO, your CFO, they're going to be the main front people in the band. But there's a huge cast of characters behind them that are supporting them through this process. They're going to be very distracted through this, and so they need other people to step up and help run the business. The people that are behind them are incredibly important. There's your finance team who's building models, educating your banking team, working on forward projections, because that's a lot of the way in how the company is going to sell the deal and build investor demand around this. How do you communicate what the prospects of the company are going forward? There's the accounting team, the internal accounting team. Rez is going to talk about the external accounting team. The internal accounting team is doing a ton of diligence work, getting all the books, the financial statements all up to snuff, working on their SOX compliance. There's a ton of work that goes around this. We'll show you a little bit about the timeline, which is in our next slide. And then finally, the other part of the in-house team, is the in-house lawyers. The in-house lawyers, you can think of them as helping quarterback manage logistics between a variety of all of the parties that are involved. And so that's where I got heavily involved in the deals that, Rez and I have worked on, which are 3 now? Yeah.
That's right.
Okay.
So Scott, when you talk about company executives and in-house counsel, what can people expect in terms of time commitment during the IPO for, let's say, the PR team, the people who are here, PR and marketing? How much do you expect of their time versus CFO, CEO, GC?
Yeah, I mean, it's really important for the PR professionals to be involved in helping craft and create the story, which, Lacey had talked about. whether or not you're involved in the S1 drafting process or not, or whether you're in the room with a bunch of lawyers or not. I think you want to be involved in what the basic story is that you're trying to communicate, because something we'll talk about in the S1 drafting process is the document. And this is what Rez referred to as the registration statement. The S1 is both a marketing document and a legal document, right? And I think most people think of it just as a legal document, but it is so important, and the key thing that investors are looking at are the description of the business, which is largely a marketing document, in describing, what your business is, how it's going to be successful, what the huge opportunity is, et cetera. And you guys are very well positioned to help influence that.
That's right. So Scott's talked about company execs, in-house counsel. I'm going to talk a little bit about external counsel. So oddly enough, I would actually say in many deals that we work on together, external counsel may be, particularly the company's external counsel, is probably going to be one of the point teams for the entire IPO. I think that the management team, the banking team, and the legal team are going to be front and center throughout most of the IPO process, because this is a very structured, routinized. It's not like a lot of other sorts of transactions where there's a lot of variability. It is really very tight in terms of how the process runs. And so your external legal counsel is going to be hand in glove with your management team, working through not just, I would say that a good outside counsel is not just providing you what you can and cannot do, but actually helping drive the process. They're going to help make sure that the S1 is written not just as scribes, but actually being thought partners with the management team. One of the things that you'll see is, and I say this with a lot of affection for the bankers, but a lot of the times the bankers have their own sort of notions and views as to what the positioning for the company should be. That really should be owned by the company, but sometimes you can use outside counsel to help as kind of a buffer between the banking team, which has their very strong views as to how things should be positioned, the company, which has its own views, and that's what should be respected. Outside counsel can sometimes help smooth that pass, in part because outside counsel can be the people who say, well, this doesn't make sense. If this isn't how the company is talking about itself, if this isn't how the company is going to be positioning itself for the long term, this just doesn't make sense to put into an S1. And so having that additional nuance can be really helpful. In addition, as we've talked about here, the outside counsel is probably going to be the one set of advisors that has pretty good mastery about what the rules are, what the can and can't do is around the PR that you're going to want to do. And if you work closely with them well before you start your IPO process, you can probably do just about everything you want to do from an IR, PR perspective, short of actually talking about the IPO in your press releases. So if you coordinate with them early and often, you're going to get, I think Ken will tell you, you'll get almost everything that's important to you done and continued through the IPO. So stay close with them.
So the next cast of characters are the bankers. And I think what's important to understand is to think about the bankers in a couple different groups, because they're not all the same. So there's the investment bankers, who are the people that have been cultivating a relationship with the company for some time. They are part of a bake-off process. That group within the investment bank is going to be involved in the drafting of the S1, the positioning, the roadshow deck. The second group is really the sales team. There's the equity capital markets folks and the investment banking sales team. And, I've heard it characterized this way: you are not their client. You are their product. Their client is investors who are buying stock, because that's how the banks make their money, okay? And so you are the product of the week that their sales team is then selling. You'll go on a roadshow. The sales team members will be talking to their investment bank, their investor clients, whether they're hedge funds, whether they're mutual funds. And during that time, they'll be building a book of orders. And that's their ultimate goal. And your ultimate goal is to have a huge order book where the deal is oversubscribed, so you have some pricing power. The last set of folks at the investment bank are the sell-side analysts. Those are the people who are writing research reports about your company, both in the lead up to the deal and then in subsequent quarters when you're on earnings. And those are the people that you're largely talking to in earnings. They're the people who are asking questions at the end of the earnings call. And so they're a little bit more independent. and, you know, publishing their views on whether you're a buy or a sell. So it's very important to cultivate a relationship with those folks. That's generally done by your CFO and your IR team.
A question about the sell-side analysts
Yep.
that are related to your bankers. During the quiet period, can a reporter engage with them for comment about?
No, no, we shouldn't. Anybody that's associated with the syndicate shouldn't be talking about the IPO, yeah, or the company.
So maybe, is there a secondary group of sell-side analysts you should consider as a communications person that aren't related to the banker but could act as a third party to journalists during the quiet period? Not that you would push those.
Yeah, I mean, I think that's exactly the type of thing you don't want to be doing, because you're talking to a financial audience purely about investing in the stock, and hyping the market.
Yeah. It also raises the question why they would want to be involved if they're not going to have a piece of the IPO.
Yep.
Got it. So typically, the only sell-side notes that come out before the IPO will come from those related to your banker.
That are not related to your bankers. There won't be any, there
Yeah.
won't be any sell-side analyst reports until probably at least 25 days post-IPO.
Yep.
You know, one thing, Scott brings up a great point about the three different sorts of bankers that you're talking about. And one of the reasons why the analysts are particularly important is if you do a traditional IPO, let's put SPACs to the side, thank God, and direct listings, some companies will use direct listings, but it's a relatively small minority. Traditional IPOs, which still make up 90+% of the market, you won't actually put any guidance out on the street. You won't actually put any forward model into the market before your first earnings report. Well, how does it get out there then? How are people building future models? It's through the analysts. So you will do due diligence with the analysts at the investment banks that are part of the syndicate. They, essentially, you will give them your model for the future. They will do whatever voodoo they do and make a couple of tweaks here and there, and then they will use that model as their own model that they will then go and sell to. Why do people live with this sort of weird structure? Well, because companies don't want to take liability on their forward guidance. And if you, for some reason, the SEC has agreed to live with the fiction that if the guidance is only going out through the analysts, that the company is not taking direct liability themselves for any forward-looking guidance around future years that they're putting into the market. And you only take that liability after you're already public and after you're doing your earnings releases and giving quarterly guidance thereafter. So it's a really important role that the analysts play.
You want to touch on the accountants real quick?
I'll hit accountants real quick. So unfortunately, these poor folks are probably the least attention gets paid to accountants during the process, but I will tell you that putting markets aside, the accountants are going to be the people who have the greatest influence on the timing of your IPO. If the markets are amenable, getting your financial statements complete, getting your audits done, getting your reviews done is going to be vitally important. So what's required for an IPO? For the vast majority of companies, emerging growth companies, so companies essentially under $1.25 billion of revenue in the last completed fiscal year, you need 2 years of audits in your registration statement, in your S1. The auditors have to audit those 2 years of audits under PCAOB standards, and they also have to do reviews of any quarterly periods since the end of your last completed fiscal year. And so they're going to be integrally involved. They will also be involved in one other very important way, which is if you've got material weaknesses in your internal controls, they're going to put out a report on that. They're going to essentially weigh in if you have material weaknesses. Now, it's not the end of the world if the company has material weaknesses in its internal controls. I would say about a third of tech companies that go public have them at the time they go public, but it's not ideal. And so for those two areas, you're going to need to be very closely engaged with your auditors. The final thing I'll say, not all auditors are created equal. And by that, I mean this. The relationship that you have with your auditor, the individual, I mean specifically the individual man or woman who is your lead auditor, will have a massive impact on not just the quality of your audits, but how smoothly it goes and how well they can manage their internal requirements. Because you remember, the auditors are not, you are their client, but they are not a service provider like a lawyer or a banker. They don't answer to you.
They're not your advocate.
They're not your advocate. And so, but you need to have that relationship with that lead partner at your audit firm, so they will be your advocate with their own internal national office, which is always a fight.
I think one of the key things that you see here is how much work is being done, particularly on the accounting work stream, before you're even like in the process of going public. Like there's a demarcation line, you can see that blue line, which is the organizational meeting, which is traditionally considered like the big kickoff of the process. There's a ton of work that needs to be done getting your accounting house in order so that you can publish the financial statements that have been opined on by the auditors in advance of all of this. And that is just there's a people, a process, a systems element to that. And that's a huge build for your CFO and your finance team. The IPO process typically really kicks off at the point where you're selecting bankers. And that can be, several months before you have an org meeting. I don't know, what are the trends you've been seeing, Rez, with how people are kind of getting on top of drafting and getting your bankers engaged before even an org meeting?
I would say, 2 years ago when the world was going crazy, people would have org meetings and then 4 weeks later they would be doing their confidential submission. Those days are thankfully, mercifully gone because the work product that came out of those processes wasn't great. I would say these days, there's a lot of pre-drafting work before bankers are even selected. Most of the book, other than the front half of business and front half of MD&A, which are really the main story parts of the business, are largely done before you even select bankers most of the time.
Yep.
And so I would say at least 6 weeks to 2 months before you're planning on a confidential submission, you'll select bankers. So working backward from there,
Yep.
You need to put out the RFP about a month before you're going to do the bake-off.
Yep. And so the banker selection process is typically called a bake-off. That's a colloquial term for it. And what we see in a traditional IPO, not thinking about SPACs and other things, is typically you'll have large bulge bracket banks leading the IPO. They're on the front of the cover. It's typically like the largest banks. Goldman Sachs, Morgan Stanley, Deutsche Bank, JP Morgan, those are some of the names that come to mind. But then when we talk about the research analysts, they're typically smaller banks that are added to the syndicate largely to pick up key research analysts, people who you think are going to be super influential in whatever industry that you're in, who are publishing reports. And those people are actually driving business to the larger bank, for those things. So like on the deals that I've worked on, we were very cognizant of which analysts we were picking to bring their whole banking team on board and giving them a piece of the IPO. Anything you'd add to the bake-off process?
I think that's exactly right. Usually the way the bake-offs will work is that you'll select 2, maximum 3 banks as your lead banks, and it tends to be some combination of Goldman Sachs, Morgan Stanley, and JP Morgan for most tech companies. I'd say 90% of deals have 2 of those 3 involved. And then there will be a number of other banks, probably somewhere between 5 and 7 other banks that get added. And it has an economic impact. The lead banks tend to get somewhere between 60 and 75% of the economics, and then the remainder of the economics is divided up amongst 5 to 7, perhaps more other banks.
Smaller
and it's primarily,
banks.
Yeah, that's right. And it's primarily, as Scott said, for the analyst coverage, because the lead banks are going to do are essentially going to do all the selling work of placing the shares.
And this is an interesting part for you guys to be involved, understanding your analyst makeup, even though, the IR team is largely driving that process. But as far as like storytelling and positioning, you want to be synced up with your IR team on those things, right? Because you guys are the master storytellers. And so there's a lot of value that you can add in helping your IR team work with the analyst to craft the story and make sure the messaging comes across right. Yeah.
Do you see communications people in the bake-off meetings?
I have not, in the bake-off meetings that I've been in, we've held them pretty close. Typically I would see the CFO, CEO, me, and then, a board member or 2. That's how we usually handle it.
But Rez, when are you brought in? When are the lawyers brought in?
Oh, most of the time actually before the banker selection. So either we've been counsel of the company since incorporation, or we're brought in, I would say, about 6 months to a year before that initial, that banker bake-off. That tends to be.
Yeah, another thing that, we've used in the past just to get a little leverage, we've asked bankers to draft the business section or like the summary of the business section as, part of the RFP process for the bake-off. So we get to see how they're thinking about positioning the company. And so that gives us a lot of information, both on how they look at us, but it's also actually like work that we can then use later in our process.
Banker selection is probably where we'd start drawing that line around the quiet period. That's where we would recommend, once bankers are selected, that's where we'd recommend you be a little tighter in your process and coordinate very closely with your internal and external legal at that point. Yes?
Yep.
Would you say that's the line that communications people should think about as having established our usual cadence of marketing? Lacey mentioned customer wins.
Yes.
So if we haven't established, as a company hasn't established, say, customer wins is something that's something we traditionally do. If we haven't done it by selecting banks, then too late.
Sorry, go ahead, Scott.
I mean, I would say that you can lean in pretty far on customer wins. I mean, it's very directed to the actual business. It's not directed at a financial audience. I don't think you want to be trying to place stories with the Wall Street Journal finance section about a customer win. But if you're in industry publications about customer wins, or you're publishing a white paper on your website or your blog, I think that's totally fine. I don't know if you agree with that.
I think Scott's absolutely right. And here's the way I would position it. Whenever you're doing something like that you haven't done before the IPO has started, think about where it's going to be put out and what you're saying when you're putting it out, right? If you're talking about a customer win and showing how a customer is using your product so that you're clearly angling it towards how other future customers might want to buy your product, that's going to put you in a lot better position, even if you haven't done it in the past, than if you put something out and saying, this $5 million a year account shows our ability to win, these sorts of business.
And we're going to drive $100 million in recurring revenue. Yeah, that's what you want to be avoiding.
Yeah.
Yes.
So I have a question. I've had folks I work with on the PR agency side
Yep.
where they want to do a product release or a customer win in a quiet period, but then there's this trend around AI, right? And a lot of the messaging is about how the company is putting forward AI, driving the future forward. So then that was a challenge during the quiet period. So when you're talking about not only the product and how you're using it, customer focused, but then as a big part of a trend in pushing the industry forward, how would you approach something like that during a quiet period?
I don't think it would give me that much discomfort. I think I'd want to be careful about how much AI hype you're having. I mean, right now, and Rez can probably speak to this better than me, but I'm seeing it at the public company I'm at. The SEC is actually coming down on companies that are using too much hype in their earnings statements around AI. And so those are things that, someone like Rez, who's working on multiple deals, seeing what are hot buttons at the SEC, on a month-to-month basis can kind of really inform. And so that's why it's really important to get an advisor, like someone like Rez, who's really has his, ear to the ground and seeing what's happening on a day-to-day basis with the SEC. I don't know, anything you'd add?
No, I think you're right. I think again, it comes back to how you're positioning it and what you're doing. If it's just jargon for the sake of jargon, I mean, it's probably not going to be a great impact with investors anyway. But again, if you're positioning it towards customers, how AI is helping your customers solve their problems rather than the hockey stick effect it might have on you and your results, I think you can continue to do it. And again, all of these things are nuanced. So looking at exactly what you're saying, if you're getting good legal support internally and externally, again, as I said earlier with Ken, the vast majority of what you want to do, you're going to be able to do.
Can you ever talk about a time where there was a company that you work with that did blur the lines during that quiet period? Really, what's the damage effect of that? Is it an issue? What's the issue? Who dings you and what happens?
So there are a few examples. Fortunately, none from me personally that ended up costing us time, but I did get a call on the eve of pricing the Lyft IPO. I got a call from the SEC literally that day where I don't even remember exactly what it was, but there was a Wall Street Journal article that had come out, and they asked us about information related to pricing, and they're like, how could this information have gotten out there? How could somebody write an article about this if it didn't come from inside? And I said, and I explained to them, now I remember, and I explained to them, I said, well, if you just look at the cover, that's where the information comes from. It's all there. It's just a writer taking the information that we put on pricing parameters and putting that into the book. There's rules. The SEC has rules around 20% above, 20% below the cover price on your S1. And so the SEC was like, how could they know that it was 20% above the IPO, and the price? And I said, well, because all you have to do is know the SEC rules and know what's on the cover, and you could do the math yourself. We didn't leak it, et cetera. But it could have delayed the IPO, or it could have put significant pressure on the disclosure. But if you look at Groupon's IPO, if you look at Google's IPO, if you look at Salesforce's IPO, each of those got delayed and put into a penalty box for a period of time. Obviously, 2 of those 3 went on to be very successful companies, 1 not so much. But they delayed their IPOs. And in a tough market, such as the one we're in right now, delays can be very, very costly.
Yeah, the Salesforce IPO is frequently used as the poster child for like what the CEO shouldn't be going out and saying. Like Mark Benioff went out and like hyped for an investor audience sometime during the quiet period, and so that got delayed. And so when I was helping put together kind of rules to the road for our comms team, the Salesforce IPO was like an example that I had on a slide, giving people like a real example on, what can go wrong. So, yeah, sure.
So I think we hit the first point about the quiet period. S1 drafting. This is something, as Ken was saying, you don't necessarily want to be involved in the whole thing. There are over 200 pages. Most of them are just jargony nonsense, so don't do that. But there are 3 sections that you should pay attention to. The first, say, 3 to 5 pages of the prospectus summary, which will essentially be a duplication of the first 3 to 5 pages of the business section, those are going to be places where if I were in your shoes, I'd very much want to be involved. That's going to be the real storytelling.
Yeah, and that's the marketing element of the S1 that I mentioned earlier. It's often referred to as the box because there's like a little box outline around that section.
Exactly. And then the only other place is the front half of the MD&A section, which is where you're explaining kind of the financial model and how that works. You may or may not want to be actively involved in that, but I think you probably will, because if you're going to be actively involved in earnings going forward, you're going to want to know what metrics and what positioning you're putting out there for how the business is going to operate going forward.
Yeah, so the SEC review process is just an iterative process where you're going back and forth with the SEC. You file the draft registration statement, what's called the S1. They give you comments back. There's a big scramble after you get the comments among the lawyers and the accountants to respond. And, that can happen 3 to 4 times. It could go longer, it could go shorter. But once you're done with that, and the SEC basically is signing off on your document, then you have the blessing to go out and really start selling your deal. And that's when the roadshow commences.
So you want to talk about, there's during the SEC review process, that tends to be the time that testing the waters meetings happen.
Yep.
And that has there's a lot of intimacy between the testing the waters and the roadshow. So you want to talk a little bit about that?
Yeah. So testing the waters is this concept of actually companies going out and talking to some, probably very large investors who they hope will participate in the IPO to start getting feedback on the story.
This wasn't allowed a decade ago.
Yep.
A little over a decade ago, the SEC passed rules to allow these meetings with investors before the roadshow. Before that.
Yeah, and I think Trulia was one of the first companies to go out and do testing the waters meetings. And so, now it's a very well-established process. Your bankers are going to go with you hand in hand. They're going to set up, a couple of these meetings. And it's really about getting feedback on the story so that then you can incorporate that into, your marketing message in the S1. What's resonating with investors? What do they want to hear? What are they worried about? Where are the things that you want to give them more confidence about? And so those are very good meetings for you guys to get the recap of. It's going to be your CEO, your CFO, probably somebody from IR if you have an internal IR person. If you don't, maybe those are meetings you guys can go on and kind of act as the quasi-IR person. But I think getting the feedback on that and what's resonating from the story would be very helpful for you as comms professionals.
And I think one of the things that we've seen probably over the last 5 to 7 years that's become incredibly important, particularly for the roadshow, is the roadshow video. And I know it's been mentioned a few times today. But, in the old days, it would be, your CEO and CFO going up, spending 30 minutes to an hour in a relatively monotone presentation with the bankers or with the potential investors.
Yeah, and so this is actually when you're hitting the road to start selling the deal,
Yes.
which is different than the testing the waters thing. So Rez is talking about the 2 to 3 weeks and just prior to your anticipated pricing. So this is where you're out actually like soliciting orders from potential investors. Sorry to interrupt.
No, that's exactly right.
Yeah.
So this is when you're literally out there selling the deal. So what's going to happen is it's going to be these days about 10 days 10 full calendar days. You don't do the weekend, but otherwise it's about 10 days. And what will essentially happen is the management team will go city to city, meeting with large institutional investors. And what it used to be is 30 minutes to an hour of direct in-person face-to-face meetings, and they're telling the whole story front to back to the investors, and then that they also leave time for questions. What's happened is now we have 5 to 15-minute videos that are really high gloss, well produced, that gives all of the basics about the company, gives a lot of the information that's coming out of the S1, positions the company in a very glossy and slick way, so that most of the time, once you're in investor meetings, can be spent with investors asking questions of management, and it's management not having to repeat itself for every single meeting, which is helpful.
So the management presentation has gotten less important in those face-to-face meetings because it's done in advance in a video.
In a video. Not in advance, but at the beginning.
Right.
Tend to be.
Right.
Yeah,
Yeah.
that's right. And then, do you want to talk about pricing, Scott?
Yeah, I mean, pricing is, happens the last day. During the roadshow, particularly towards the last several days, the bankers are giving you a report every day on like, how does the book look? How many orders do we have? How, oversubscribed or undersubscribed are we? And that's going to dictate like where you're going to have your range and how you're going to price in the range, below the range, above the range. And so literally the logistics of pricing is the night before the deal. There's a pricing committee of the board that gets on the phone with the CEO, CFO, and the bankers. You get a report on the bank on what the final book looks like, and you make a decision on what price you're going to, go out at. And then that's communicated. And then the next day, you actually start trading.
You start trading. And this is where there's some nuance again for the PR and IR folks.
Yep.
So once you start trading, you are not quite as tightly bound anymore. Obviously, you can mention the IPO at that point. But what you need to be careful about for the next 25 days, once you go effective on your registration statement, so as Scott was talking about pricing, the SEC will declare your registration statement effective. That means you can officially sell stock. You can sell stock, you will price the deal. By the next morning, your stock will start trading and it will have been sold. And now that you've been declared effective on your registration statement by the SEC, the same strictures don't apply in terms of what you can say and can't say. But you want to be very careful for the next 25 days. Why? Because there's something called a prospectus delivery period. It's bizarre, it's arcane, but essentially what the rule says is that for that next 25 days, any material changes to what you've said in the S1, you have to update your prospectus. And so what we always tell people is, look, if you're going on CNBC and other places and doing interviews, go do them. Go talk about your company, go talk about your business. Don't put out new material information for that period of time. Wait till earnings. Try to be don't be stilted, but try to keep it in line conceptually.
Just talk about the things that you've already talked about in the S1 that are, any financial information is just, backwards looking about how you've performed and what you've disclosed. And then you can talk about the business and your plans, everything that you've talked about in the marketing section of the S1. So it should give wide latitude for your CFO and CEO to talk to, media.
Yeah.
Yeah.
So the 25-day period afterwards, are you saying like if you still had product launches, like normal course of business, just go for it?
Fine.
Good.
Totally fine.
But if there's a major product launch, like if it's an earth-shattering product launch, I would mention it in the S1 that this is what you're expecting to come, these sorts of products, and then just be consistent.
I have one question about the pricing. Presumably, there's an advantage to kind of underpricing, so there's hype the day of. Can you just give us a little insight into that? Because I think that plays into the PR story that we tell about momentum.
Yeah, there's a lot of pressure on companies to kind of underprice by a couple bucks so that you can get a big pop. And so there's, you're perceived as having a very successful IPO. There are pluses and minuses to that. Obviously, the media plus can be big. At the same time, the company is, not getting as much money because they're selling their stock for less than they could get.
Right.
So.
And Scott's exactly right. There's a lot of push and pull. Some directors on your board will say, absolutely, we want to have a pop. Other directors will say, absolutely not. We don't want to leave any money on the table. So that dialogue, that's one of the reasons why direct listings came to be, is because people didn't want any pop. Some people were trying to optimize pricing, and so the logic was, well, direct listings are full transparency. The market just prices it as it goes. So it's a great question, probably beyond the scope of a definitive answer.
Yeah, but I think one thing is like executives at your companies, if you can get ahead of these things and be advising your CEO and CFO that these questions are going to come up, so you're not like dealing with them on the pricing call, rather the board's had a discussion or your pricing committee's had a discussion in advance, and so people generally understand what the overall strategy is on pricing, that's a good thing to be doing in advance. And so, you know, you guys are going to be advisors to these executives. If you can help them think through that, it's really important.
Scott, Rez, thank you very much.
Thank you.